And yes, the Zoom is going to be recorded and it's going to be posted in Wealth Squad University. We try to give Ender a day or two. He has such a large, list of things to do. So we try to give him a day or two to put it into the community.
But if y'all want to speed them up, just add them. Terry, Ba, Wa, or go ahead and ask your question.
Hey, how y'all doing?
All right, how are you?
Doing well. Yeah, I'm just trying to understand better the process once a contract is like about to expire, like the things you need to think about as far as just keeping it and having the cash on hand to execute it, or just letting it expire. I'm trying to understand that whole process more, things you need to think about, and how you actually do it.
So you're saying basically when your contract is getting ready to expire, what should you do? And you said execute. You said execute.
Sorry.
Oh no, go ahead. I'm sorry.
Yeah, the things you need to think about when you're trying to make the decision about, am I going to actually just let it expire without executing the contract, or am I actually gonna make sure I have the cash on hand to execute it.
Okay. Is it expiring in the money? Are you expiring? Is the contract rather expiring in profit or not?
So the way I think about it, I would only be interested in executing it if it's in profit, right?
Right, because that's the only way that you can. You can only exercise your contract if it's in profit. That's when your break-even price matters, because what essentially is happening is that profit is going to be utilized for you to be able to purchase 100 shares of the underlying stock.
Exactly.
Mm-hmm. So that's basically a decision that you have to make, whether or not it's worth actually owning the shares for whatever the particular company is that you are trading. Mm-hmm. It has to be worth it to you. Otherwise, you can just take the profit from the contract and maybe, invest it in something else.
Okay. And I use Webull, right? So if you don't do anything, what does the broker automatically do if you don't do anything? If you don't,
your contract will expire in profit, and if you do not select the option to exercise it, then it's just going to secure the profit for you. It's not going to exercise the contract. There is a checkbox.
Yeah, I've seen that checkbox.
Mm-hmm.
Yeah,
and that's
okay.
If you select that checkbox, then that means that you are wanting to have your contract exercised, which means you want to own the shares.
Okay. Yep. Mm-hmm. Okay. So it's just a mathematical equation and if you have the cash on hand, those are only two things you really got to think about.
Right? When you say have the cash on hand, what do you mean?
To actually buy the shares that you'd be responsible for.
So if your contract is expiring in profit, then you're able to exercise it, which is putting you in a position where you're able to purchase the shares of the underlying stock.
Yeah.
So yes.
Okay. Thank you.
No problem. Yeah, the next person.
Kia, you can go ahead and ask your question.
Hello, everybody. Thank y'all for taking my question. I was trying to figure out, sometimes I have options that are not in the money, they're unprofitable, so I'll try to get out of it. But then it'll say like something about it is too short, like it's not able to let me out of it because something about the shares are too short or something like that. There's like an error message that comes up, and then I have to let it go to zero because I can't even.
No, that happens. That happens when you are trying to submit multiple orders on the same contract. So for example, let's say you're trying to get out of your contract and you go ahead and you try to close that position, and let's say you wait a minute or two and nothing happens because there's no one willing to buy it from you. And then you go back in and you're like, okay, well, I'm going to change the price maybe, and I'm going to submit it again. You have to actually go to your original order and edit it from there. So you're going to either cancel it to resubmit it, or you can edit that original order to cancel. Normally when it says that to you, it's because you have a pending order already out there.
Oh, hold on. My bad. Oh, let me exit on mute or so.
Mhm.
Did you get that, Q?
Okay, I got that. Thank you so much. I was trying
No
to figure
problem.
out why. Is there ever a time when, I got one quick question. Is there ever a time when it's like the amount is too small that of each, I guess the strike price, so it doesn't allow you to get out of it? Like sometimes the strike price might be like 3 cents or something. I don't know. And hopefully
Not-
this makes sense.
Yeah, you're making sense. You're just saying strike price. Your strike price is going to be completely different. Your strike price is what you're expecting for that particular stock to reach by that certain expiration date. But what you're referring to is going to be the premium, the amount that you paid, or what's left, whatever equity that you have left in that particular contract. So basically, what
Okay.
happens is you may be putting it at a rate where it's too high. So, for example, let's say when you bought it, it was worth 0.50, right? And so
Mhm.
now it's reversed all the way down to 0.15, but you have it at 0.25. Nobody wants that because it's not worth that. So what you would have to do is you're going to have to either meet them somewhere in the middle or reduce it all the way down to get out of that contract. Normally, when your order hasn't gotten fulfilled, it's because you're asking for too much. You know what I mean? When you're trying to get out of a contract. And sometimes when it's essentially worthless, if it's like 3 cents left on your contract, probably nobody wants to buy that. You want to make sure that your contract is not reversing to the point where you're all the way, at a
Gotcha.
70, 80, 90% loss.
Okay, that makes sense. Okay, thank you so much.
No problem. And then everybody who has a question similar to that, like for example, when your order hasn't gotten filled, let's say you're trying to submit an order through and it hasn't gotten filled, typically it has a lot to do with, is there anyone that's willing to buy it at that particular amount, right? And then if your order is still pending and you're trying to get out of a contract, it has a lot to do with the amount that you're trying to sell it for. I put information into Market Facts and Resources, and it's under why your order hasn't gotten filled when you're trying to sell. And then I also have another one that says why your order is still pending or hasn't gotten filled when you're trying to get into a contract. All right, so let's go to the next person.
All right. iPhone, you can go ahead and ask your question. Actually, don't mute yourself.
How y'all doing? Can you hear me?
Yes.
Yes.
Awesome. I just had a question. Can y'all run down the benefits of in the money versus out the money? Like I understand the concepts, but I don't understand like why you would want to purchase out the money besides like a cheaper
Premium.
it's cheaper premium. So can y'all like go over that part? Because I don't see the benefit of going out the money besides it being cheaper.
Absolutely. And also, number one, when it comes to in the money, that is basically giving you a lower risk position. So basically, if you're buying in the money, you're trying to eliminate as much risk as you can. When you're purchasing a contract that's in the money, it's close to, or the stock's price has already reached that amount, right? So the chances of your contract expiring worthless is smaller. And I'm not saying it's completely eliminated, because if you buy something that's in the money at $20 and the stock price is at 21, if something, catastrophic comes out about that particular stock and it drops all the way down to 15, at that point, your contract is not out of the money. So it doesn't guarantee that you're not at risk. Now, when it comes to out the money, obviously the cost is cheaper for you to take the trade, but you want to make sure that the stock has the potential to reach that particular strike price by that expiration date, or at least move into that direction, because you do not have to reach your strike price in order to see profit off of that particular stock. So when it comes to in the money and out the money, in the money has intrinsic value, out the money has extrinsic value, but it's a difference in premium that you're paying that's beneficial to you. One lowers the risk, and then the other one obviously has a little bit more risk, but it's cheaper to actually take the trade for out the money.
Okay. Okay, I understand that. So profit wise, my last two parts. So profit wise, if it goes as planned, right, the way that you planned it to go, then starting in the money would be more profitable, correct? And then as far as eliminating risk, if I have a smaller account or I'm just getting into options, would it not be smarter for me to play towards in the money?
It's actually the opposite, which is kind of crazy, right? You're out of the money, higher risk, higher reward. Always remember that. You actually see more profit in most cases when you're playing out of the money because you have that extrinsic value that you're playing on. So the more risk that you have, the more profitable you'll be. When it comes to playing in the money, it removes that risk. So it's almost like, well, we know you can make money off of this. So why would we pay you extra? That's the way that I think of it. But you can think of the higher the risk, the higher the reward.
As well as Kate, I think you put it in market facts and resources, like the option profit calculator. So that's the other thing you would want to look at. Put your contract into option profit calculator and see, you know what I'm saying, what are the risks with it and how much you would make. Well, the risk would be how much you pay for it, but how much you would make on it. Or if you use like Thinkorswim or something like that, you can use the analyze tab in there and see, you know what I'm saying, how much you would profit based off of how much the stock would move based on certain dates and stuff like that. All those things that equate into that contract moving.
Yeah.
Okay. I appreciate y'all. Thank you.
No problem.
Edward, you can go ahead and ask your question.
Yes, thanks for taking my call. I want to know what is the ideal expiration date for if you day trading?
We can't say the ideal expiration for day trading. It's going to be based upon what the stock can actually do, the average true range of the stock or how the stock can move. When you're day trading, I mean, you can set a 0-day expiration in some cases, or you may want to give yourself a little time, even if you are day trading. But we can't say get a day for today or get a day for tomorrow. It's depending on the implied move of that particular stock.
Okay.
And what you would think it's gonna move. Like once you figure out how much you think it's gonna move, then you'll be able to figure out what type of expiration you would want to get.
Yeah.
Based off the ATR.
Yeah.
Okay. Now, one last question is, when do you enter trade? I mean, like, what are the key indicators for you to know, to enter into the trade?
There's
on a bullish side.
Well, the knife cuts both ways. So like if you're trading the strat, that's going to be like a very long question to answer because there's so many different indicators and strategies out there. I know Ray trades the strat. I trade the strat, but I also know how to use indicators as well. We did a video on indicators. I also put into the community indicators to buy calls and puts, and we did a video on that in Wealth Squad University. So my recommendation would be to watch that video. Or you can actually start with the strat as well, and that'll help you too. And Ray put information on the strat into the community as well.
All right, thank you so much.
No problem. And you guys, that video is indicators to buy calls and puts, and it's in Wealth Squad University. And then we also have the strat, which Ray did, which is in Market Facts and Resources, and he did videos in Wealth Squad University as well.
All right, let me get the next person. Chris A, you can go ahead and ask your question.
Hi guys, thanks. Can you hear me okay?
Yes.
Yep.
Hey, similar question to the 2 questions ago, so I apologize if there's a lot of overlap, but didn't quite hear it addressed. Going through y'all's materials, I've bought some classes from you guys, going through some stuff on YouTube, and really confused about for example, a call out of the money and a put in the money. They're both betting on the stock going up. Why would you do one versus the other?
They're not betting on the stock. A put in the money is not betting on the stock going up.
Right.
Puts is betting on it going down. It's just the in the money, out the money is flipped.
Right.
And so that may cause some confusion, but a put you're betting on it to go down. So like if you're betting on a call going up, right? So a call is for it to go up. In the money is going to be anything less than what the stock is, right?
Right.
But for a put, in the money is going to be anything higher than the stock, because basically the prices already went down and past that. So that may cause confusion, but a put is always going to be betting on the stock going down.
Ray, do me one favor, because I want to make sure that everyone has a thorough understanding of in the money and out of the money for calls and puts, because I know when I first started trading, it was very confusing for me too. So I can understand why, it may be getting lost on some people. So if you could do me a favor in the Wealth Squad, in Market Facts and Resources, go to number 22, and let's just walk through this together. Okay. Let's see here. All right. So you guys, I have this example here because I want you to understand the difference between the two. So whenever you hear the word put, just think to put down. That basically means that you're basically saying that the price is going to go down. When you hear call, think of call up. You're expecting for the price to go up. So when you're looking at something that's in the money, think of this. The stock has already hit that price. It has already exceeded that price. So playing anything in the money means that it's already hit that price. So for example, if the stock is $10, you know that anything between 1 and 9 would be in the money, right? Anything that is considered at the money would be wherever the price of the stock is currently. So at the money is what the current price of the stock is. Anything that is out of the money, the stock price has yet to hit that price. So if it's $10, if it's $10, anything above $10 would be out of the money because it has yet to hit that price, right? So that's how you would think of that. When it comes to a put being in the money, you're basically saying the stock is already at that price. Out of the money, it hasn't hit that yet. So hopefully that makes sense to you guys. If for a put to be out of the money, then it means that it has to fall to that price because it hasn't hit it yet. Because the mindset is that a put is going down, the price is going down. So if it's at $10, then out of the money is going to be for a put is going to be $9, $8, $7, if that makes sense.
Right. And then I'll put, let me know if you see this, Kay. I'll put it over on the screen, TD Ameritrade, real quick. So like one of the easier ways to tell if it's in the money or out the money is the blue or the lighter color would indicate in the money. So for calls is on the left, puts is on the right, as you can see, puts, calls. All right. So everything in the blue is basically in the money for calls. Everything that's black is out the money. And then you go over to the put side, everything black is out the money, everything blue is in the money. All
right. But I kind of just wanted them to understand because everyone doesn't use the same trading platform. So I want you guys to have an understanding. Even without that, it's good to just know because not every platform is going to lay it out for you that way. So it's good to have a fundamental understanding of what in the money, at the money, and out the money is. All right.
All right, get the next person. Daniel, Marshall, you can go ahead and ask your question.
Hey, what's going on, y'all? Thank you guys for taking this time to help us out with this stuff. My question for you guys, so I've been looking at leaps with my schedule. It just is better for my anxiety. And so specifically, I was looking at Ashford Hospitality Trust, and I looked at, I want to say a December 21 leap with them. The $10 one that I was looking at had nothing listed for the Greeks. What does that mean? And obviously, like right now, it's not something that I'm comfortable looking at because I don't know how it's going to move. But what does it mean when there's no when it's like all zeros listed for the Greeks?
Who do you trade with, and when did you look?
Webull, and I think it was yesterday that I looked.
Okay, so you're not gonna. So one thing that it could be, and this is just me surmising, but it's the weekend, so it won't update on the weekend. That's one thing. The other thing is sometimes there's glitches within the brokerage, but If it's outside of that, what I would highly recommend you doing is to wait until it is updated,
Okay.
because you don't want to jump into anything without the information that you need to make, a high probability trade and a good decision on the trade.
All right. And then also, is it typical to have the high volatility with those, the high IV? I think it was like over 150 or something like that.
How long were you looking at your leap? Was it 1 year, 2 years?
This was for I think it was like December 21st, 21.
Okay, so that's not going to be a leap.
Okay.
That's more of a skip. Your leaps are going to be a year or more.
Got you.
So, and with that being the case, then it's possible for the IV to be high because it's not considered a leap.
Okay.
But if it were a leap, typically your IV is extremely low and your theta on your contracts is extremely low as well.
Yep. Okay. All right. Thank you.
No problem.
All right, Brian, you can go ahead and ask your question.
Hi, thank you. I just wanted to make sure I'm clear on the calls and stuff that are made in the options ideas. So when they put out like the tickers, obviously, I'm just reading one from Chris at the moment. It's AMD 611 would be his expiry date, yes, of his contract. And then he's got a price, like a dollar price for 82 would be, I'm guessing, his strike price. And then the next number would be how much he's paid for the contract. Am I understanding that correctly?
Oh, so you just need a breakdown of basically okay.
Yeah,
okay.
so in the options, current option ideas. So when
Gotcha.
Chris or Keely or Michael puts a call in there, just being clear on what they're writing.
Absolutely. So in Market Facts and Resources, and this will help you for anyone who's trying to figure out what the difference in the whiteboard and current option ideas is and what we're talking about. Number 31 in Market Facts and Resources is going to break down your options, right? So basically, whenever we're saying the ticker, so yes, you are right. The ticker is basically going to be the stock's abbreviation. We give the expiration date, which is the date in which that contract is going to expire. We're giving you the strike price, which is the price that we want the stock to hit by that expiration. We're also going to indicate if it's a call or a put, and we're going to put the average cost, which is basically what we're paying or trying to pay or wanting everybody to try to get in at for that particular contract. And so we put a breakdown into Market Facts and Resources.
Perfect, thank you.
No problem.
iPhone, you can go ahead and ask your question. I don't know which
Hello?
Yeah.
Okay, y'all can hear me all right, good. Yeah, I got
We can see you too.
really my bad. Yeah, because I was in the chat trying to see where market and resources are. I didn't even know. I'm still trying to figure out Discord. So
Okay.
okay, but this is my question. Okay, I bought an option, and at first it was in the money, and for AMC, but I bought it to expire this Friday, and maybe 2 days before it's expired, I bought it, right, and then it was in the money at first, but then the day it dropped on Friday, like AMC dropped. When it dropped, it went out of the money. And but if I sold it before this day of expiration and just lost $1,700 off of it. Because I didn't know if an option goes into the expiration date. On the expiration date, if it's out the money, but at some point of time of the day it hits the money, but then goes back out the money, does it profit once it hits the money, goes into the money, or does it have to be in the money when the option expires?
It would need to be in the money especially when you're dealing with something extremely volatile like AMC has been right now, because like you said, one day you were extremely profitable and you were in the money, the next day you were out of the money. And so, and then you also have to factor in IV crush as well as the theta decay, which completely kicks up on the day of expiration. So yes, you would definitely want that contract to expire by meeting the strike price. Otherwise, it will be worthless.
Okay, yeah, and that's why I went on to sold it, because I didn't know, and then I was last minute, literally like right before the market ended on that Thursday. I was looking at videos of how to sell it and stuff, because I was having the same issue that the first chick said she had. Well, I guess I was asking for too much and it wouldn't process the buying of the contract, and then I what it's done. I was asking less. Now, going into what's all this stuff where they talking about this squeeze, the pseudo squeeze or whatever squeeze supposed to happen with AMC, would it be better to buy AMC if I did want to risk some money? Would it be better to buy actual shares of AMC, or would it be better to buy a contract? And then if I did buy a contract, what should I use to determine the strike price? Because my sense say, hey, just buy the lowest strike price as possible, and I really don't care how much the premium is, as long as I guess I like trading my risk down just listening to y'all talk, before we got here. But what would be the smartest way to play AMC from this point out, if it was gonna go to this $1,000, $2,000 like everybody talking about?
Okay, so let me see if I remembered all of that.
I'm sorry.
All right, so 2 things. Your options contracts are extremely riskier or more risky than buying actual shares, because shares are not tied to an expiration date. So you would have to determine, based upon your risk tolerance and what amount of money you have, if you're okay with, potentially losing it all with options, or would you rather, have a smaller gain than you would with options, but at least you're not tied to an expiration date where you're losing all of your money. That's number 1. Number 2, I highly recommend that you get familiar with the options profit calculator, because that will let you know what you stand to lose and or gain if the contract or the stock does not do what you want it to do by the expiration date.
Okay.
Also, picking your strike price for AMC, you're just going to have to study AMC to see how it moves. So if you can look at a daily chart and you see this stock, and I'm just throwing out a random number, I'm not charting it, I'm not looking at it. So if you were to look at AMC and you look at the daily candles, and you're looking at the daily chart rather, and keep in mind every candle on the daily chart represents 1 day. If you see that AMC moves $15 in a day, then you say to yourself, hey, on average, it can move $15, and you have a strike price that's $30 out of the money, then you say to yourself, I'm going to at least need, really, you would say 2 days, but I'm always giving myself more room. So maybe you want to go out a week. I don't know. You have to determine that, but you're going to be looking at that particular chart to see how long it takes to make that move.
Okay.
Mm-hmm.
Okay, that makes perfect.
Okay.
Okay, and yeah, and I think the only mistake I did was I bought the option for Friday, because it's like I could have. And then another thing is, why would options that's in the money be cheap? Just like, because I saw options, like I bought the $32 option, and the $32 strike price, and then when I went back and looked, it was ones that was lower than 32 were like cheaper, or like the one next down was cheaper than the one I bought. It's like, wouldn't it make more sense just to buy what is the cheapest in the money?
So the deeper in the money that you go, the more expensive it is. The further out of the money that you go, the less expensive that it is. Because keep in mind, the more in the money that you are, you're basically giving yourself, how can I say this? You're minimizing your risk. So you're going to pay more because you're minimizing your risk more. So the deeper you are into the money, the more you're lowering your risk.
Okay.
Mm-hmm.
Well, thank you so much.
No problem. It was good seeing you. Next person. I'm just messing with y'all.
Also, people, y'all understand AMC is not normal. All right. So don't base your options career on AMC because that ain't normal. It don't move normal. When you look at that chart, that's an abnormal chart. It's a lot of factors going on there than what's actually going on with other stocks. So
yes.
Don't think.
And
Go ahead, Kay.
No, I was just gonna say I encourage you guys to really watch what is going on. And I'm not knocking anybody for playing AMC. I played AMC myself, but what Ray is saying to you guys and what I'm saying to you guys is that it's defying technical analysis. There are hedge funds that are placing bets on this. There are people who are literally placing bets on AMC, right? So you guys have to realize that this is outside of normal trading. So a lot of people are coming in, hey, AMC Gorillionaire, a lot of people are coming in because they see these massive gains from AMC, but it's so much deeper than what you all, are thinking. So please understand that, because I don't want you all to just jump in blindly. The people who are trading AMC have been watching AMC like crazy.
Also, look at where the price is at. All right. Don't just be randomly listening to people be like, oh man, AMC going to 1,000. Check this out. If I told you the sky was green, would you believe me? All right. So don't believe with something that's at $50 is going to go to 1,000. All right. It's only a few stocks that's even at 1,000. All right. So don't be that person that will listen to the man at the corner store. So, Jerron, go ahead and ask your question.
Hey, how y'all doing? Thanks for taking our call. I got a question about the ATR, using that indicator when you're selecting your contracts. Do you want to wait? Because when I'm looking at it, it's at the bottom, it's low. Do you want to wait till it kicks up before you actually input your option?
What do you mean it's low? The average true range?
Yeah, the average true range is. Go ahead.
It's going to be specific for that particular stock.
Okay. Because right now I'm using it as a stop loss for swing trading, but I'm trying to figure out how to use it as a option indicator.
It's not that. It's not a momentum indicator. It's definitely not going to tell you what the stock is going to do.
Right.
The average range is specifically to let you know, on average, what range or dollar range the stock can move. Right. So it's not a momentum indicator, and please don't use it for that way, because I don't want you to lose money.
No. I use other indicators, but okay. I was just trying to, because I'm picking between two different contracts, and I want to pick the right contract. So I was using a ATR, like if it goes from 1 to 2 in a given day, maybe that would be the contract that I would use, because the range is actually moving.
It's okay. So let me let you know. So the average true range is going to give you, if you have it on the default setting, it's going to give you the range that the stock moved over the last 14 days.
14 days, right?
So let's just say it shows 5, then it's telling you that on average it can at least move $5, right?
Right.
So you would use that to see, obviously you're charting your levels, you're supporting your resistance, and you're making sure you're entering, if it breaks to the upside or breaks to the downside, you're entering for a call or put based upon that. But when you're using your average true range, it's letting you, it's helping you to decide a strike price based upon what it can do day over day.
Got you. Yeah. All right. So that's what that answers that question.
Yeah. So like, I'm gonna give you like real simple math, right? So like, you have a stock that, I'm so sorry, my alarm keeps going off. You have 4 days, right? And it's $20 that you see. That means that it can move $5 a day if you were to break. You get what I'm saying? Like it's basically giving the average of what it can do. I don't think I said it right, but
I'm understanding.
Yeah.
I'm understanding what you're saying.
Okay. All right. Cool.
Go ahead.
I was gonna say, as well as she went over ATR. If you go to Wells Squad University 523, it says today's option swinging class. That's where she talked about like how to pick contracts and how to use ATR. It was like a really good class. She killed that one. So if that's something you want to go over as well, to like really get a full like actual, like I think it was like 30 minutes she spent on that lesson. If you want to get something in depth, that's it right there. And it actually gives you the examples, and she goes through how she picks the contracts and stuff like that and the math behind it.
Okay. Yeah. I appreciate that. Last thing, what's the difference between a covered call and a regular call, and do you use the covered call version?
A covered call basically is when you have 100 shares of the company and then you sell a call. That's a covered call, because what happens is if somebody chooses to exercise that contract that you sold to somebody, right, because it ends up being in the money, you have to give them your 100 shares. So that's where the 100 shares come from. It comes from somebody who's selling the call. So do I personally use that way? No, I don't. I don't have 100 shares and sell a call. So I don't do covered calls. I just do basically what they would call naked calls. I basically just buy those.
Okay, I appreciate it. Bless y'all.
No problem. Rhonda Brisky, you can go ahead and ask your question.
Hi, thank you guys for all you do. So my question is about the Greek. I've been looking, well, my brokerage account is in Fidelity, and I've been looking at it, and I noticed that what you pulled up showed several different options to choose from in terms of the Greek. Right. And it doesn't look like Fidelity offers that same thing. What trading platform are you using that you showed there? And which one is Chris using when he's using those, when he puts a call out there, or I'm sorry, information out there about an option that he's getting into on the whiteboard?
I don't know which one Chris is using, because Chris has been switching. I don't know if he uses it through M1 Finance now. He was with Thinkorswim TD Ameritrade at one point, but I don't know if he's still using that for his options or not. So I don't really know his personal information like that. But as far as mine, I'm using Thinkorswim, and Thinkorswim normally doesn't even show it. You have to I had to go in there and edit it to show the Greeks and stuff like that, because the default version, it doesn't have it. So I had to go into the layout and actually add that stuff to my chart. And that's probably what's going on with your Fidelity. It probably doesn't have it on default, but if you find the settings, you could probably change it and add it to it.
Okay, because I was like, okay, it looks like they're just giving me one option to choose from. And I'm like, but I don't know what the Greeks are. So I don't want to buy something that is going to ultimately lose me money because I have a high theta and a low delta.
Right.
So you said that. I'm sorry, Kay?
I just pulled up a video where you can look on Google with Fidelity on how to pull up the Greeks. It basically is under navigating and customizing the option chain, because sometimes you have to alter it just a little bit so that it's catered to the things that you want to see based on what's important to you when choosing a contract. So if you just go to the Learning Center in Fidelity, it has the area that shows you how to customize your options chain.
So you said it was navigating and customizing your options chain?
And let me just tell you what I put in to search it. I said, because I don't trade with Fidelity, I use Webull. But I know that we have quite a few people who are in the community who are starting to use Fidelity. So I just typed in Google how to view the Greeks in Fidelity. And the first thing that came up is just letting you know how to customize your options chain.
How to do the Greeks in Fidelity. Thank you so much.
No problem, no problem.
So Tara Wilson, you can go ahead and ask your question. Kind of breaking up a little bit.
The potato, Miss Tara. We can't hear you.
Okay, so my question, can you hear me? You can.
Yes, we can
So
hear you
my
now.
question is, so my question is, and I don't know if this just happens with Revo or if it happens with the other brokerages. So
It's
I
hard to
had,
hear you, Miss Tara. I'm so sorry. Can you leave the house party for a second?
oh, you can hear all that? Oh, I'm
Yes.
so sorry.
It's okay.
I'm sorry, my nephew graduated today.
Oh,
I apologize. Let me go outside. Thank you.
Congratulations. Miss Tara trying to get her money at the house party.
Okay, can you hear me better now?
Yes. Yes, we can hear you perfectly.
Okay, can you hear me better now? I'm sorry.
Yes, we can hear you.
Okay, hello?
Yes.
Okay, so I had purchased a option on the same day. So I purchased it on Friday and 45, and this was Webull. So my
Miss
question
Tara, can you go
that
back closer?
happens-
You're off the Wi-Fi. We can't hear you now. We can't hear you. You're breaking up.
same day to close, but they had closed it out. So
I really want to help Miss Tara because she left the whole party to ask this question.
Yeah, and it looked like she just left.
Oh,
Kicked her.
Miss Tara, if you hear us, please DM me or try to hop back on.
Yeah, I think what happened was she was trying to say that she probably bought a contract the same day, did a 0-day expiration, and then it basically ended up getting rid of it at the end of the day or something like that.
Oh yeah, 3 p.m. It's done.
So I think that's what it sounded like. But just go ahead and go to the next person until she come back. Christine Carter, you can go ahead and ask your question.
Hi, everyone. Hi, Kay. Oh, I think you have a beautiful personality. I just wanted to say that before we start.
Thank you.
You're welcome. My question, I actually have two questions. When you're buying a contract for any stock and you're looking at the strike price, is there any resource that can guide me as to what would be, how can I say this? What would be, okay, if the contract is, let's say, $80, how would I know that that's not overpriced for the strike price I'm going for? Like, is there any way I can look at a resource that kind of outlines what you should be paying for a contract, or that doesn't exist?
Oh, okay. I get what you're saying. You're talking about your premium. Is there something to tell you that you're overpaying for your premium?
Yes.
You'll know if you're overpaying for your premium depending on your levels of support and resistance and where you're entering at. If you don't have a high, or if you have a high risk to reward, then you're overpaying for your premium. If you're getting a bad entry on your contract, you're overpaying for your premium. So it's tied into your technical analysis, if that makes sense. So for example, if I know that a stock is going to reach resistance at $20 but I'm entering into a call and its support level was at, if its support level was at $15 and right now it's at like 19, then I know once I enter, I'm overpaying for my premium because the support level was at $15. So my risk is higher than my reward at that point, if that makes sense.
Yes, it does. And what was the other one? You said risk high to reward. And
you want to make sure that you haven't, like you're going to have an uneven risk to reward if you're entering a call like too close to the next resistance point, right? You at least want to make sure that it's going to break through and you want to enter close to that point so that you don't have an uneven risk to reward. That's why I gave the example. If the support level is at 15, the resistance is at 20, and you're entering at 19, it has $4 to where it can drop, but it only has $1 to move up. So that's an uneven risk to reward. So you're going to be overpaying for your premium because you're entering in at the wrong place. So you're going to gauge it based upon where you enter. You're overpaying if you're not calculating, or if you're not factoring in your risk to reward.
Okay, because the system already knows the support and the resistance. So that's for me to look on a chart and know as well.
I would say there are certain algorithms and there are certain levels that all traders see and that the systems can pick up on, but I wouldn't necessarily say that the system is, well, maybe, I don't know, technology these days, I don't know. But I would just basically watch your charts and make sure that you're entering at your appropriate levels. And like I put into the community before, you don't want to chase stocks when it's run up too much. If anything, you want to catch it on the reversal. And I think that's where some traders are going wrong. They're chasing stocks that have like pretty much done their implied move. So you just want to catch things like that on the reversal.
Exactly. And that'll sometimes be indicated with the implied volatility. If the implied volatility, which is kind of hard number to say, I think, Kay, what we say, we normally try not to get anything that's like really over 100. But sometimes what happens is people will hop in on something that's been running up. So the implied volatility is high on the contract. So then once that move has happened and the stock starts dipping, they start losing money because the implied volatility starts decreasing, which also starts to decrease the price of the contract through the Greek Vega. So that's why it's good to learn the Greeks and stuff like that, so you can make sure that that doesn't affect you, which usually also happens to after earnings. A lot of times the implied volatility would drop, which would indicate an IV crush. That's what usually happens. And then that's why people lose money as well, even if the company has had a good earnings, which is why I stay away from earnings personally.
Thank you so much, Ray. I appreciate that. And my last question is, when I'm usually in the chat and, people are talking about their gains off of a option and they're mentioning percentages. If I buy a contract, of course, I get nervous if I see it begin to drop because I don't know how far it's going to drop. What area, like, and percentage wise, should I be like, okay, this is enough, don't be greedy, just take what you have, or wait and see if it turns around? Like, how should I look at my percentages?
By what your account size in and what you're willing to risk, right? So for example, I'm an advocate of people having a majority of their money into stocks or a higher percentage just invested. And, the lower end of that being into options. So that's going to be dependent upon your account size. You know what I mean? If you have $1,000 that you want to trade with and you say, I'm going to put 30% of that towards options, then you would have to figure out like what your risk tolerance is based upon what you're trading with. And everybody is playing with different money. You know what I mean? So for example, somebody who's playing with $1 million, losing $10,000 to them may not be anything, but losing $10,000 to someone else could be a lot. For someone, losing $100 could be a lot. So it's going to be based upon what you can afford to lose, basically. And I always tell new traders, starting out, you want to compound, take 10 to 20% and keep snatching 10 to 20% from the market, because it's easy for a stock to move 10 to 20%. That's simple. And you keep doing that over time and just compound until you get a decent enough account size. So maybe 10 to 20% or maybe 20 to 30%. And just think of it like that.
Okay. And my last question, thank you for that. My last question is usually because I can look at the stock market most of my day because of my job. So normally I see that the stocks by the afternoon have already ran up. So at that point, I'm kind of hesitant if I should even enter because it seems like it's been running since the market opened. So would you say that the best entry time, not like entry and exit on a stock, but as far as like purchasing an option, would be like the morning time versus the afternoon?
I'm so happy you asked that question. And I hope that there are a lot of new people in here that have the same exact question, because I want everybody to understand that stocks do not move on a clock at all. Now, there are particular things that investors do during certain times of the day that can impact the stock, but the movement itself is not going to be at 9:30, 10:30, 11:30. It doesn't work like that. So What we do know, just based upon what we see, is that a lot of traders like to take money first, take profit first thing in the morning because of their anxiety of holding overnight. But we don't know what the best time for anything would be when it comes to trading. That's why when a lot of people ask, when are they going to call another trade? We're basically going off of what the stock is giving us. And we can't do anything more than that. We can't force trades. So what I would recommend, if you can't watch your account all day, you may want to be like me. And I started doing this because I couldn't watch my account all day, but I still do this because I feel like it's more beneficial. You may want to get into contracts that have longer expiration dates if you can't, because at least if it reverses, you have more time for it to recover.
Okay.
Mm-hmm.
Thank you. But that brought up one last question. I promise this is the last one. I promise. When you say get a contract that has a longer expiration date, let's say, for example, I have a stock that moved $2 and I have one expiration date for June 18th and another one 2 weeks ahead. Is the profits going to be the same for the one that's the 18th and the one that's 2 weeks after the 18th? Or is it going to be higher for the one that's farther out?
There's no way to say because we don't know what the implied dollar move is exactly going to be during that time frame. But what I will say is that 9 times out of 10, you're going to have lower theta than the one that has the closer. You're going to have lower theta on the one that has the longer or further out expiration than you would on the one that has the closer expiration. So the profits are definitely going to be different because of that. You're giving yourself more time for it to reach the dollar move with the one that has a further out expiration.
Okay. All right. Thank you both. I appreciate it. I hope you have a great evening.
You too. Thank you so much.
Also, you could check that with the option profit calculator, see what the differences and stuff would be, so y'all would know the profits on the contract. Miss, I think you was calling Miss Tara. She's back. Go ahead, Miss Tara, and ask your question.
Okay, so I had purchased through Webull, and this has happened to me twice. So it happened a couple of weeks ago and it happened on Friday. I had purchased the option on the same day, and my plan was to sell it on the same day. And Webull had actually executed the option at 3:45, and I was wondering if that's something that the brokerages do, or like if you knew, or if that's something that Webull does, because I actually had activated the do not, they have a tab that says you don't want them to do that, but they did it anyway. And I was wondering if that happens when you purchase an option on the same day and then want to execute it on the same day, if they automatically do it at 3:45.
So that's good because Webull actually gave you grace because most brokerages will execute at 3 p.m. If you selected do not exercise, then it didn't exercise it, but because it expired on that day, they executed it, which basically means they closed it out on your behalf and took profit if it was profitable for you, or I don't want to say took profit because people think they actually took your money. They gave you your profit if it was profitable, and if not, they just closed it out. Now, when it comes to exercising, that's completely different. Exercising is basically where you are saying, because I'm in profit with this stock, I want to be able to own however much I can afford of the underlying stock with this particular profit.
Also, as well, was that on Friday that happened, or was that a different day of the week?
It was on Friday. So it happened, actually, when I think about it, it's happened the other time that I did it, it was a Friday as well. So it was the SPY.
Okay,
So
that makes a lot of sense. I was also just
because it trades up until 4:15 p.m. So that's why you had a little grace, Ms. Tara, on that, because SPY trades up until 4:15 Eastern Standard Time. Typically, they close it out at 3 p.m.
As well as I wanted to make the difference, because sometimes what'll happen is people will submit an order and it never gets filled. And they'll be like, well, why cancel it for me? And the expiration is a couple weeks out. It's because it never got filled. So I just wanted to make sure that wasn't an issue you had.
No, I was so mad too, because I could have gotten more money. So that's why I was a little bit mad, because I'm like, I could have executed it myself and made more profit. So it happened with that one and Wayfair as well. They had did that. Both were in you know, they were in profit. But anyway, so I was just checking to see. So you're saying that usually it's at 3 o'clock.
Usually it's at
Same
3
day.
o'clock. It's
Okay.
when it's the expiration date, it's at 3
Mhm.
o'clock on the date.
Okay.
Mhm.
Okay. Thank you guys. I appreciate
No
it.
problem. Congratulations to your nephew too.
Okay. Thank you.
No
Enjoy your
problem.
evening.
Miss Tara's hair is beautiful. All right, let's keep. We getting close to the time. Well, it's 4:59.
We'll take one more. All right, Ebony.
Okay.
Ebony, go ahead and ask your question.
Thank you for taking my call. Can you guys hear me okay?
Yes, ma'am.
Okay, great, thanks. So I feel like I'm the poster child for what Christine's questions were about, which was really about a call that I had on Merck back in January when it was a true leap for January 2022. At the time, it was before they gave up on their COVID vaccine. So I was again betting on, you know, the stock going up to 120, which was the strike price. At the time, it was, I think, still around 70. So I think my question is, should I give up on it now? I think the last call was at the price for that call was like $13 and I paid $46 for it. I know we're just in June, so there's still 6 more months. And the theta is still about, well, the delta is still about 8.5 times the theta. But again, the support's not there. So would you give up on it and just go ahead and sell it for the 13 or whatever it is when the market opens? Or do you just let it expire worthless and just lose the 46?
So you're saying it was a vaccine company, right? And then they gave
Yeah,
up on
Merck.
If the reason why you bought it, if that reason isn't there anymore, then I would go ahead and sell it, because that would
Okay.
basically your catalyst is gone. So if that's
Yeah.
the reason why you
Okay.
bought it, then it's best to go ahead and sell it, because that was the only reason why you got it. And the thing about it is, if it goes against your anytime you're trading, if it goes against your hypothesis, it's always best to get out.
Okay.
So always stick to that. Like once you see that it's not going what you thought it was going to do, whether it's news or it's price action on the chart, always go ahead and get out, because you can always get back in if something
Okay.
ever changed. But you want to minimize your losses and stuff like that and cut it as soon as you can, because that's what's going to keep you in the game of trading options as well as building your portfolio.
Great. Thanks. Beginner's ignorance. Thank you so much.
You're welcome. All right, everybody, that was the last question. Kay, you got anything?
No, I don't, but I don't want the people who feel like they didn't get a chance to answer their questions to feel like they can't still. You guys know that we still are going to be in the community. We try to give it, a hard stop at an hour. But other than that, you guys, it means a lot to us to let us know how you like the class within the community, how you like the class on your socials, at us at the Wealth Squad. And that's pretty much what I have for you guys. Y'all have made me lose my voice.
Good. It sounded horrible. Yeah, follow us on our Instagrams and stuff like that. iCurlyK is iCurlyK. If you're looking for me, I'm Ray Jensen. I'll type it in the chat. Yep, and just add us, let us know what y'all thought. And like I said, next week's class for the people, hopefully all of y'all come in there, but make sure it's going to be on basically swinging option trades basically with the strat. So that's going to be the next class. So go ahead and get caught up on what the strat is in market facts and resources, because that's what I'm going to be talking about next class, as well as I'm going to do some things in Thinkorswim that kind of helps me, but you can always use option profit calculator with it. But I just want to show y'all the power of Thinkorswim. So we appreciate y'all. Catch y'all next time. And if you have any questions that you need answered, just DM us.
Love y'all. Bye.